And okay. All right, guys, I admit I am just really nervous. I don't know why. It's just Haley on the other end, and I know she's like totally fine, but it's just different doing it this way. And I am kind of stuck right here so that I can make sure she has access to everything we're doing. So it is going to be a little bit different, but I know you guys will be all right. Okay, so we are going to spend today on investments the entire day. We're just going to continue to review investments. And then on Monday, you know that your analytical procedures are due. So, and your inquiries for Mike. And so Monday we'll kind of get started with year 4. But today we're just going to keep reviewing. I know you guys struggle with homework. That's fine. It's hard. We're going to do more problems today after we go over the homework. We're going to just continue cranking out some problems. But I also want to kind of go back and revisit short-term investments. I don't know, I'm going to leave the door open. It's more fresh air. You may be louder, but it's more fresh air when the door is open. So I want to go back and revisit short-term investments just because it's been a while, and I don't know if Sandy even got those in her class or not. So hopefully you all had a chance. I know it was a lot, but I did, I do have all the videos from last semester posted for you. If you didn't get, a chance to watch all of them before today, that's fine. You've got them. You can go back and revisit them anytime you want. But the first one is basically like the lesson that we did for how to account for short-term investments. And then I gave you a couple of examples of accounting for short-term investments. You may remember that if you went back and watched it, you'll remember that year 1, the first time we do short-term investments, it's easy. The second time it gets a little bit harder, and especially when we sell short-term investments, that's when it gets more complicated. So we're going to go through all that today. We're going to work a problem from start to finish on short-term. And then equity method. So this was the original explanation for the equity method where they would pay only book value for the stock. And then we did an example, and then I gave you one more example for each one of those 2 things. This, I think, was our very last homework from last year, where, again, you just had some examples for equity method and for short-term. And then I did happen to have the lecture from Monday. I happen to have that one taped. I don't remember why. I think I used to travel more for this position. So I may have just had thrown it up there for a class when I couldn't be here. I was like, wow, they might just like to have it to review it. And so you've got that as well. So you've got a lot to go back to if you need to on investments. And so, and again, basically an hour of our normal class time each week is moving online. So we're, you may think, oh my gosh, that's going to be so much time to have to go back. But, think about that extra hour you've got that we're not sitting here. So it is going to seem like there's more on here than we're used to. But remember, that's because we're not in here for a whole hour that we're used to being in here. Okay, one more thing I just want to mention real quick on our teams. Okay, so hang on one second. Let me get back to, now I got to figure this out. How do I get back to showing you okay. I have created channels for each group, and those are private. So you will be able to talk to just your group members over Teams, just like you did. I know a lot of you set up Zoom meetings when we were online last semester. Same thing, you've got your own private channel. I can see it, but I mean, I don't plan to be in there unless you need me to join in with you. Like if you want to have a group meeting with me, when it gets time to start doing financial statements for year 4 or whatever it is, I'm happy to do that. Or if you just want to use your channel to meet with me, like for instance, if Kyle just wanted to ask me some questions about homework, we can jump on your channel and do that. And Dawson and Sandy don't have to join in. Okay, so we can absolutely do that. We also, again, we have a business department channel that eventually we'll get everybody added to. It's a lot of students. But for now, know that those channels are there, that they are private. So if you guys want to work on something together, you are going to be able to keep your, not that, I mean, I'm sure you're all just so worried that somebody's going to see your set of financial statements, but just so that you know that it is private and only your group is going to be able to access it. So please know that that's there, and make use of it once you need to. Okay. So I'm thinking that we might actually start with short-term investments. I know we did homework on equity method, but since we did short-term investments first last year, I thought let's go ahead and do the short-term investments first today and just review it. So on Connect, you will see, and Haley, are you still seeing everything?
Yes, ma'am.
My screen, you're still seeing it?
Yes, ma'am.
Okay, great. All right. At the very bottom of the investments section is this short-term investment practice problem, is what it's supposed to say. Okay, so if you'll go ahead and download that. And I actually have it on a PowerPoint. It doesn't really matter which one I type on, I don't think.
Actually,
but you can't see it?
I'm seeing your, I'm seeing the PowerPoint.
Yeah, that's what I just pulled up.
Okay.
The PowerPoint. You're seeing, it says Investor Corporation purchased the 600 shares?
Yes, ma'am.
Okay. And I apologize, guys, if it sounds like I'm having a conversation with myself. Haley's in my head. Okay. Yes, Tyron. Yes, we're going to do this one first, I think. Okay. So, and Haley, the problem itself is on Connect.
Yes, ma'am. I have it.
You got the problem. Okay, great. You guys have it in Word, but I'm going to do it on PowerPoint, if that was the confusion, Haley. You cool?
Yes, ma'am. Sorry.
Okay. Sarah, go ahead. Did you find it? Okay, so it's in the investment section, the very first section. Okay, at the very bottom is a Word document. Yeah. Very, 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 you may, Did you have it pulled up like earlier today? If you do, you need to refresh, because I would have done this about an hour ago. Got it? Okay. All right, so I went ahead and did it in PowerPoint because it made it easier. I already had my little T account set up and everything in this PowerPoint. So I'm just going to type it onto PowerPoint, but it doesn't matter whether we're in PowerPoint or Word, it's pretty much the same. Okay, so just a reminder, what we're doing, we looked at, we opened that PowerPoint the other day and looked at the fact that basically our idea here is we're looking at investing in the stock of another company. So we are a company. We are looking at investing in the stock of another company. And what really matters in how we account for this investment is what kind of relationship we have with that company. Okay, and I apologize, I'm getting a notification on Teams, but I don't think it'll bother us. No, okay, good. So what kind of relationship do we have with that other company? Now, we quantify that by what percentage of stock do we own, basically. So if we own between 0 and 20%, we're typically going to be looking at short-term investments. And that used to be called trading securities and available for sale securities. So you may hear that at some point when you get out in the work world and you're dealing with people like me, like old people, who learned something one way and it was that way for years. Sometimes it's hard for them to adjust back to the way it is now, to the changes that FASB makes. So if you ever hear anybody talking about trading securities or available for sale securities, they're really just talking about short-term investments. Okay. So if we own between 0 to 20%, we're typically going to be recording it as a short-term investment. If we own between 20 and 50%, we're typically going to be recording it as an equity method investment. Okay. And one thing that I know you guys know, the accounting for the two is drastically different. Okay. If you may not remember the accounting for the two exactly right now, but we do know that depending on which one we've called it, the accounting is really, really different. And the reason that is true is because the relationship is so different. So a short-term investment, we don't have a relationship with the company. We are investing in the company to make some sort of gain on that stock or to receive dividends from that stock. But we are not in meetings with that company. We are not on the board of directors for that company. They are not coming to our offices to meet with us, or there's no strategic reason. Okay, it's basically just let's make some money, right? We just want to hope, we're hoping their stock price is going to go up and we're going to make a gain. And that's really the only purpose in investing. We had to do something with our cash to get some return. We bought some stock. So the accounting for that reflects that relationship, that there basically is no relationship except we are trying to make a gain. And so what we're going to do with that is record gains and losses. Okay. Now, the difference, short-term investments are also different than other types of assets. Okay. So most of the time when we record an asset, we leave it at its historical cost. And we talked about that last time as well. So if we buy land, we leave it at the price we paid for it. If we buy equipment, we leave it at the price we paid for it unless it actually goes down in value, and we depreciate it. If we buy inventory, we leave it at the price we paid for it, right? So all of those assets we record at historical cost. Short-term investments are different. They are an example of an asset that we are actually allowed to write up in value, and they're the only asset that we are allowed to write up in value. Do you remember why they are the exception to the rule? Why can we write up a short-term investment, excuse me, when we can't write up anything else? Remember? Okay, let me give you a hint. All right, so let's say that we own a piece of land in downtown Atlanta. We bought it for $50,000. I imagine it'd be worth quite a bit more today. Okay, so let's say it's probably worth now somewhere between $500,000 to $750,000, depending on which realtor we talk to or which appraiser we talk to. Why can't we write that up? I mean, if we only paid $50,000, but it's worth between $500,000 and $750,000, why can't we show that land at its fair value? Why are we not allowed to do that? Yeah, Tyron? Right. What do you mean it would be inaccurate? Why would it be inaccurate? We do. Okay. Okay. So it's definitely more reliable and verifiable to use the historical cost, right? Like, I mean, we can go to the invoice or the deed or whatever it is, and we can say, here is $50,000. We paid for that, right? But on the other hand, I'll just be devil's advocate for a minute. If I were an investor, wouldn't I be more interested in the fair value of the land than the historical cost? Wouldn't I want to know how much that land is actually worth today? Wouldn't it be more interesting to me to know that they have a piece of land that's worth considerably more than just that $50,000? So why can't I write it up? That's possible. Yes, it could be very cyclical. Okay, Tyron? Okay. So, I mean, you guys are all around it. You really are. Okay, so the main reason that I can't write it up, the land, is because it would be really, really hard for me to find 2 appraisers or 3 appraisers or however many appraisers that completely agreed on the exact value of that land, right? I can't on my balance sheet put down land 500,000 to 750,000, right? I can't have it in a range, at least not right now. Maybe someday we will. Maybe someday we'll figure out, and they're moving towards fair value accounting all the time. But at the moment, I can't have a range on my financial statements. My balance sheet won't balance if I've got 500 to 750,000. And if the appraisers don't agree, which of those 2 amounts do I choose, right? What if somebody says, no, it's really only 300, but somebody says, well, it could be $1 million you could sell it for, right? It's just not, it's very difficult to verify that fair value. And so if I'm trying to protect investors, which we go all the way back to those first presentations, you guys remember those? So whoever did my SEC, my Securities and Exchange Commission presentation, the reason that we do accounting the way we do, the reason that we're conservative is because part of what caused that stock market crash of 1929, golly, we're coming up on 100 years now. Part of what caused that was because companies were just writing up their assets however they felt, right? And there wasn't anything behind it. There was no verification that that was what it was really worth. So because we are conservative, we want to protect investors, and nobody's going to agree on the exact value of land until you sell it, and then you don't need it anymore because it's not on your balance sheet. We just recorded that historical cost. Okay, that's a really long road around back to short-term investments, but it's important because all that stuff we did at the beginning of 3301 to set the regulatory environment up, we are always going to come back to that, guys. Always, always. So now, what makes stock different than that piece of land? Why can I write it up? I know exactly how much it's worth at any given time, right? I can turn on 50 different channels on my TV and get stock quotes. I can look on the internet right this second and tell you how much something is selling for on the stock market. Yeah, Tyra? It's verifiable. Exactly. If I'm doing a 12/31 balance sheet and I want to know that how much was Nike stock selling for on 12/31 at the close, we are all going to find the exact same answer to that on the internet, right? That is verifiable. So that's the difference. I can't go on the internet and find out what that piece of land in Atlanta is worth right now because not everybody's going to agree on it. But I can go on the internet today and find out how much Nike stock is selling for right this second. And that is verifiable. So that is why FASB allows us to, and I'm sorry, Sandy, I'm assuming you know that's Financial Accounting Standards Board, right? Because she worked with the Accounting Standards Codification in her class too. So perfect. Good. Okay. Well, we talk about them a lot too. So you're in good shape having done that. So the reason that FASB allows short-term investments to be accounted for differently and allows you to write up those investments through the market adjustment account is because it is verifiable, okay? So I know I just took like 20 minutes of our time, but I think that that's really important because you've got to understand why we account for assets differently. Why is this an exception to that rule, okay? So because the purpose of a short-term investment is to make that short-term gain, or to, even if you're holding it for longer, it's to make a gain on the stock and to get dividends on the stock, hopefully. The way that we account for it is to show those gains and losses immediately. So every time we do a balance sheet, whether it's quarterly, monthly, yearly, whatever it is, but every time we do one, we're gonna have to show the change in value for those short-term investments. That's our purpose with those, okay? So very, very different purpose than what we do with equity method investments, which we'll put off for a little bit and we'll talk about in a few minutes. Okay, so here is our short-term investment problem. And let me get the numbers so I don't just sit here and start guessing the numbers. That would be fun in my head. All right. So Investor Corporation is going to purchase 600 shares of Company A and 500 shares of Company B. And when they did that on 1/1/20, Company A was selling for $60 and Company B was selling for $45. Okay. So we can lump those together into the short-term investments account. Just keep in mind that we would have subledgers in our accounting system that would keep those separate. But in here, we're going to put them together because on the balance sheet, they would be joined together into that short-term investments category. So altogether, they would be paying $58,500 for those two stocks. Yes. Together. Yes, please just go ahead and make them together because that's what, because when we show them on the balance sheet, we're going to be showing them together. Remember we use the portfolio, we called it the portfolio method. So we're going to, even when we do the revaluation, we're going to revalue them together, not separate, okay? All right, so there's our first entry that we're going to have to make. All right, so now investor is going to be preparing quarterly financial statements. And they are going to, as we talked about before, they are going to have to show the short-term investments at their market value. Okay, so it's either going to be writing them up or writing them down. We don't know yet, but they're going to have to show them at what they were selling for on 3/31 because it is totally verifiable to do that. So what we do is we start out with the fair market value of those two stocks on 3/31. Okay, so no, don't want to do that. Just want to move it. Okay, so A was selling for $63. They own 600 shares. B was selling for $47. They own 500 shares. So we're going to do 63 times 600 plus 47 times 500. And the fair market value on that date is going to be, let's look at it real quick. So that's 58. I only have the final answer. 61,300. Okay. Now, when we do a revaluation, we are going to compare that to the original cost of the stock. So the cost will always be the same unless we sell or buy something. We'd always go back to that original journal entry. And so we paid $58,500 on that for that original, that was the original cost. And that gives us the target market adjustment. Now, in the first revaluation, it also gives us the gain or loss, right? So you may think, well, why don't we just do gain or loss there? Only in the first revaluation does it give us the gain or loss. The second revaluation, it does not. So that's why I always say just call that your target market adjustment and it will make your life easier. All right, because we have to solve for the gain or loss every other time. The target market adjustment here is going to be $2,800. So basically, A and B went up in value $2,800 during that first 3 months that they owned them. So what I want, and so if it's positive, that's a debit because market adjustment is a asset account. So a positive amount is a debit. So what I want is for the market adjustment to have a final balance debit of $2,800. It currently has a zero balance because we just bought the stock. So what am I going to have to do to market adjustment to get it from a zero balance to a debit of $2,800? I'm going to debit it for $2,800, right? I love the first revaluation. It couldn't be any easier than it is, right? So I'm going to have to debit it for $2,800. Okay, this is where I like to write. Sometimes Yeah. Probably easier if I just don't, because it just always ends up being kind of messy. Okay, so our journal entry then is going to be a debit to market adjustment, short-term investments. I'm going to write it out mostly this time, and then I'll abbreviate next time. $2,800. And a credit to unrealized holding, gain or loss. In this case, it's a gain. I'm going to abbreviate just to keep it in the space there. Short-term investments, you guys know that's what that means. $2,800. Okay, so let's talk about those two accounts real quick and where we're going to find them. Because again, it's been a while since we did this. So the market adjustment account itself is going to be on the face of the balance sheet. It's going to be shown right underneath the short-term investment account in current assets. So we would show, on the balance sheet, we would show short-term investments, $58,500, and market adjustment right underneath at $2,800. So it would bring the value of the short-term investments up to $61,300, which is their fair value, which is what we're showing on the balance sheet. The unrealized holding gain is going to be shown on the income statement. So even though we have not made an actual gain on this stock, we haven't sold it, so we don't have a realized gain yet, FASB does allow companies to show that unrealized gain on the income statement itself. Again, that's a very unusual thing. It's not very often that we can show a gain that hasn't been realized, that we haven't sold it and made the gain yet, that we can show that on the income statement. This is just a very strange accounting, okay? But we are going to show that unrealized holding gain on the income statement itself. Okay, any questions about that first revaluation that would happen? Every time we do a balance sheet, we have to do the revaluation. So we always show the short-term investment at its current market value, its fair market value. Okay? Now, on April the 5th, investor sells all of its shares in A for $65 per share. Okay. So once again, we do start with the fair market value, which in this case would be $39,000. So that is $65 per share times 600 shares. Okay, so it's just however many shares times the current selling price is your fair market value. Now here's where doing the actual sale differs than doing the actual valuation. All right, so on the revaluation, we subtracted the cost. On the sale, we subtract the mark-to-market amount. The mark-to-market amount is the amount that the stock was selling for on the last balance sheet date. Okay, so the last time we revalued it, how much was it selling for? Okay, so let's go back. Because this is only A, and we had them together, so we can't put the 61.3, right? That wouldn't make any sense. But on the balance sheet revaluation date, it was selling 600 times $63, which is 37,800 of this was related to A. So 63 times 600, and that's our mark to market. Okay, so the mark to market, once again, is just what was the stock selling for on the last revaluation date. So 37.8. So now this time we don't have a target market adjustment either. We have the actual realized gain, and it's a realized gain because they're selling it. Okay, so if we sell it, it's realized. All right. So I'm going to put an underline there. Realized gain is $1,200. No, sorry. Yeah, $1,200. So the total gain on this stock is the difference between the $39,000 that you sold it for, and it was originally selling for $36,000. So it's a total gain of $3,000, right? But I can only show $1,200 of it when I sell it because I showed $1,800 of it already in my unrealized gain. So if I were to show the full 3,000 again, I'd be double counting the gain, and I can't do that. So it's weird, guys. I know it's weird. Okay, it seems like, well, why can't we show all $3,000? They sold it for $3,000 more than they paid for it. But because of the way FASB requires us to do the accounting, we've already recorded part of it when we did the revaluation. So we're just going to record the rest of it when we do the sale. Okay, I know it's odd. All right, so the journal entry would be a debit to cash because we're selling it. And that's always going to be the fair market value on the date of sale. Okay, so the 39,000 is the fair market value on the date of sale. So that's how much cash they're going to get for that stock. Sometimes we have another debit. In this case, we don't, but sometimes we do. But since we're typing it in, we can always add a space if we needed to anyway. We are going to credit short-term investments for the original amount that we paid for A. That was $36,000. We have a realized gain of $1,200 that we just figured out. And that was $1,200. And that doesn't balance. Okay? So we obviously have to do something else. Well, remember that back on our revaluation here, part of this market adjustment related to A. So we don't want to leave that in the market adjustment account if we're selling A. That doesn't make any sense. We want to take that back out. So the amount that's in here that related to A was $1,800, right? Because it was selling for $3 more times 600 shares or $1,800. If it's easier for you to have two separate market adjustment accounts, I'm totally fine with that if you want to keep track of them separately. But remember when you do the journal entry to put them together, okay? So our last thing is going to be a credit to market adjustment because we're going to take that out of market adjustment. $1,800. Okay, so I'm going to stop for a second. And I can see that we're definitely not going to get anywhere near done today what I wanted to do, but that's cool. We're just going to do our best. That's all we could do this semester, right? Is just do our best. So we will, if we don't get equity method done today, that's okay. We'll just work on it on Monday. All right, so let me stop here because we did get to start short-term investments in class last semester, but when we did the second revaluation and we did the sale and all that, that was all when we were online. So I know that may not have been as clear because we weren't in class. So let me stop here before we try to do that second revaluation. Are there any questions on the sale itself? Yes, Sandy. Yes, exactly. So it was selling for 63, and originally they purchased it at 60. So that's a $3 gain basically, and they had 600 shares. So 1,800 of this 2,800 was A, and 1,000 of it was B. Okay. So since the 1,800 relates to A, I need to get it out of there. So all that'll be left in this market adjustment account will be the 1,000 relating to B. Okay, good question. Anybody else? Okay. So now it's June 30th and they're preparing quarterly statements again. And now the only one they own is B. Okay. So now we're going to do the same process that we just did, that we did here. We're going to do the exact same process here. So the nice thing is that once you understand how to do it, it doesn't change. Sales will always be done this way. Revaluations will always be done this way. Okay, so that does make things a little bit easier. All right, so the fair market value of B on the 6/30 is $41 per share times 500 shares is how many they own. So the fair market value is $20,500. The cost is the original amount. Now we don't have that because we put them together, but we can go back and look at it. So they originally bought 500 shares at $45 per share. So the cost was $22,500. So you can see that the target market adjustment is going to be a negative number, right? It's going to be a negative 2,000 because the cost is greater than the fair market value. If the target market adjustment is negative, that means it is a credit balance, okay? So if it's negative, it's a credit. If it's positive like it was here, I didn't write that. If it's positive like it was here, it's a debit, okay? So positives, debit, negatives are credit because market adjustments are assets. And so it follows the rules of an asset. Okay, so let's go back to where we were with our market adjustment account at the end of the first revaluation. It had a debit balance of $2,800, right? So I'm going to put that up here. But then in our sale, we credited it for $1,800. I'm going to put that here. Sorry. Okay. So when we started this revaluation, the market adjustment had a debit balance of 1,000 left. Everybody see that? Okay. We want it to have a credit balance, so the ending balance needs to be credit of 2,000. So how am I going to get it from a debit of 1,000 to a credit of 2,000? What do I need to do? Am I going to debit or credit? Okay, it's currently sitting at a debit of $1,000. I want it to be a credit of $2,000. I'm going to have to credit it for $3,000, right? To bring it all the way from a debit of 1,000 to a credit of 2, I actually have to credit it for $3,000. So it's basically, I'm crediting away the 1,000, and then I'm doing an additional credit of 2,000 to get it to the 2. Does that make sense? Yes? Okay. So I've got to credit it for 3,000 to get it. Like, I'll just write it in here so you can see it. Put it in a different color. Oh. So I'm going to oops, but I need to move it over because I got to credit it. Okay, so I'm going to credit it, just make it red. I'm going to credit it by 3,000 to bring it to a final balance of a credit of 2,000, okay? So my journal entry will be a debit to unrealized holding loss. Okay, so this time I've got a loss. Anytime I have to credit the market adjustment account, that means I've got a holding loss. So it's going to be 3,000 credit market adjustment short-term investments 3,000. Okay. So we will definitely be doing this for WebWorks again because they still have short-term investments left over from, they bought some in year 2, some in year 3. I think they sold one in year 3, but they still have some left. So we're going to have to do this revaluation for them. And so we'll get to practice it again. Okay, and they maybe sell, I can't remember if they sell anything in, I don't think that they do. I don't think they sell anything in year 4. Sorry, we're in year 4. So, but they do have to do the revaluation every time they do a balance sheet. They have to do the revaluation. So we'll definitely get to do this again, and we'll get to practice it again. Okay. If you're looking at this and you're like, go back and redo it. Okay, go back and redo it yourself. Work through all the numbers. And if it still doesn't make sense, come see me, or we can talk over Teams, whatever you want to do. And I can even give you more problems, if you want to do them. You can always, for those of, everybody but Sandy can go back to 3301. There's definitely problems in there. Sandy, I can give you problems, okay? So, but don't forget you also have, if you haven't watched them yet, you've got this example and this example that are going to do the same thing as what we just did. Okay, they're going to give you revaluations and sales of short-term investments. All right, so you've got those to watch. Okay, so let's look at homework. I think we got almost 20 minutes. So yeah, Cindy. It's not different. It's just easy. It's just all it is this very first. This one, yeah. So we started slowly with short-term investments in here. So when WebWorks purchased them in year 2, all we did was the purchase, journal entry, and we just did this one, and that was it. Okay. Then in year 3, they sold one, so we had to do this, and then we had to revalue again at the end of year 3. So we did it a little slower. So that's why you're only going to see. This one's only going to have that very first revaluation. This one will have the harder time of having to deal with the last one, the one before it. It's a little bit harder when you have to go back to that first one. That's all. Okay. So this one is a good start. Well, nobody wants to watch me right now. It's a good start, and then this one just builds on it. Okay. All right. So let's look at homework. I think I've already got it pulled up. All right. But we most likely are going to need to do equity method on Monday as well. Okay. So we'll get started, and then we'll probably end up doing some more equity method on Monday. But you've got a lot of videos to watch on equity method if you need to, too. Okay. So let's at least try to get this problem done, and then we'll see if we can get the other one done or not. All right. So Herald Corporation is our investor, and they acquire 20% of the outstanding common stock of Otis for $400,000. All right. So, oh, Haley, I'm so sorry I dropped you. Okay. Are you still there, Haley?
Yes, ma'am.
Okay, good. All right. So I haven't heard from you in a while. Okay, and I'm sorry that I dropped you. Hang on.
You're fine.
Okay. All right. So the important thing we need to know is not the 20%. It's the fact that the investment gave Harold the ability to exercise significant influence over Otis. So that is an equity method investment. When we hear those magic words of significant influence, we know we have an equity method investment. Okay, so the book value of Harold's share of Otis's net assets, and here I am throwing lots of terms at you, and I told you I would do it. Book value, net assets, net worth, assets minus liabilities, all those things are the same thing, and I'm going to use them all because you got to get used to them. Okay, so the net assets were $300,000. So Harold paid $400,000 for something that if we were to look at the balance sheet for Otis, it would only be worth $300,000. Okay, so now we have to figure out why would Harold pay $400,000 for something that on the balance sheet is worth $300,000. And the reason that we have to know that is because if it's because of a depreciable or amortizable asset, we got to make one more journal entry, right? And so I'm probably always going to throw in something that has to be depreciated because I want you to make that extra journal entry. Okay, So the excess of what Harold paid over book value is attributed to that should be a trademark. Apologize for that. A trademark, which is undervalued on Otis's balance sheet and had a remaining useful life of 10 years. Now, just because it's undervalued doesn't mean that they're accounting for it wrong. Just remember, they can only record it at historical cost, and trademarks and patents and all those things are weird anyway. Intangible assets are weird because a lot of times the only thing that you can actually record is like legal fees to defend them or something like that. You can't even put a true value on those. So most of the time, intangible assets are going to be undervalued on the balance sheet. Okay, so and then for the year ended, Otis reported net income of $90,000 and paid cash dividends of $20,000. All right, so we know we've got 4 journal entries we're going to have to make, and I didn't ask you to make them, but quite honestly, I would say this would be probably difficult to figure out these 2 things if you don't do the journal entries. So we're going to do the journal entries, okay? All right. The first journal entry is the purchase of the stock. So we're going to do, you can call this a bunch of different things. Let's just call it equity method securities, but you could call it investment in Otis if you wanted to.
I can.
Yeah, go ahead, Haley.
I'm sorry, I still just see the PowerPoint.
Oh, okay. Hold on one second. Haley's not seeing this. She's seeing the PowerPoint. That is so weird. Okay, let me go back to Teams. Oh, I know why. Okay, I have to actually switch the screen every time. That is, see, this is exactly what I need to know, Haley. So yes, thank you so much. You're going to help everybody else that I have to deal with. I have to do this in my 2200 class in a minute because I got 3 students in quarantine. So thank you. You're going to have made their lives so much better. Okay, can you see it now?
Yes, ma'am.
Awesome. Okay, so 400,000 and credit cash 400,000. Oops. Okay. The next journal entry that we always make, whether they paid exactly book value or more than book value, doesn't matter, is we are going to record Harold's share of Otis's net income. To do that, we are going to debit equity method securities. All right. So Otis reported income of $90,000. Harold owns 20% of Otis. So they can record 20% of 90,000, which is $18,000. That is a credit to investment income. Equity method securities, 18,000. Okay, so let me stop there. Anybody have any trouble with that? Because you had to know that to get the answer to A and B. Okay. The third entry that we are always going to make, assuming that they pay dividends, okay, which in all these problems they do, is we're going to record the dividends. And we have to record Harold's share. So that's going to be a debit to cash. So Otis paid dividends of $20,000. 20% of $20,000 is $4,000. So Harold would have received a check from Otis of $4,000. Now, here's where the equity method differs from short-term investments considerably. Normally a dividend, so in short-term investments, a dividend is going to be investment income. And it is not going to be the case in equity method because equity method is a very different type of accounting because it's a very different type of relationship. So as we talked about at the beginning of class, short-term investments, we're dealing with, we want to make a gain. There's no relationship. We don't know you. We don't care about you. We want your stock to go up so we can make a gain. Equity method, if we're buying that much of a stock and we have influence over the day-to-day operations of Otis, there's some kind of strategic purpose behind us purchasing Otis. We need to account for that differently. We're not trying to just make a gain on Otis's stock. We're actually trying to build a relationship with Otis. So we're not writing Otis up to its fair value. You notice that. We don't do that here. Even if Otis is publicly traded, we don't ever write the stock up in the equity method up to its fair value. We leave it at the 400,000 we paid for it. So that's totally different accounting than what we just did, right? And definitely different, we get to record our share of the company's net income, even if they don't pay it out in dividends, we get to call it investment income. Very strange, right? But again, the purpose is different. FASB has a different purpose behind this because it's a different relationship. I kind of think of it as short-term investments. We're at the most, we're just dating. Maybe not even that. Like we wave at each other, okay? Equity method, we are engaged. Okay, it is serious. We are engaged to be married. So it is a completely different relationship than me waving at somebody as I cross through campus. I am now engaged to be married. That's how different the relationship is between a short-term investment and a equity method. And then when we get married, that's when we actually purchase over 50% of that stock and we now own the other company. We'll deal with that in advanced accounting, okay? All right. So we do not record it as investment income. Dividends are not investment income. They are actually a reduction to the investment account itself. Okay. Now, if we pay more than book value for the net assets, and it's because of a depreciable asset, so it's those two things, right? If we pay more and it's because of a depreciable asset, we have a fourth journal entry. That's the only time we have the fourth. Okay, now we got to figure out what that amount is, right? So the difference is $100,000, right? So the amount that we paid, I'm just going to write this down here, and then I'll go back up and put that fourth journal entry in a second. So Harold paid $400,000. And the book value, I'm going to call that BV. Okay, I sometimes call it the carrying value as well. I told you I'm gonna NA would be net assets, I guess. Going to use all those terms because you got to know them. So book value was 300,000. So the excess paid was 100,000, right? In this case, all 100,000 is attributable to a trademark that has a useful life of 10 years. Okay, so I could have said part of the 100,000, let's say like 50,000 of the 100,000 was attributable to a trademark. What would the other 50,000 have been? If only 50,000 of that 100,000 was attributable to the trademark, what would the other 50,000 have to be? Goodwill. Okay, so if I don't panic if it doesn't always equal the difference. The excess is not always attributable to something, to an asset. It could also be goodwill. If it's goodwill, we can ignore it and we don't have to do anything to it, okay? But in this case, all 100,000 was attributable to the trademark, so it all has to be amortized over 10 years. So all attributable to the trademark. So the trademark amortization. Oh, amortization. There we go. Trademark amortization is going to equal 100,000 divided by 10 years. So each year, for the next 10 years, we're going to have to do a journal entry which amortizes the trademark by $10,000. Okay? So up here, I'm going to come up here and make my fourth journal entry, and it's going to reverse the second one. It's going to be a debit to investment income for 10,000 and a credit to equity method securities, 10,000. So the answer to A then, how much would Herald Corporation's income increase? Well, there's only 2 out of 4 journal entries that impact investment income, and that's 2 and 4. So it would increase by the difference between the 2. We had an increase to income of 18,000, but a decrease of 10. So Herald's net income would increase by 8,000. I'll just do the 18,000 minus 10,000 or 8,000. Okay, did we get that? Did we get that on? No, we didn't get that on homework. Okay, that's okay. Does it make sense now? Yeah. Okay. All right. All right, we got 3 minutes left to do our second one. And we can do it. Yeah, tired. The answer to B? Okay, now the answer to B is what is the carrying value or amount of, how much is Harold's investment in Otis worth? Notice that all 4 journal entries had the investment account, right? The equity method securities account. So all 4 journal entries are going to impact the answer to B. So only 2 of them impacted A, but all 4 are going to impact B. So B is going to be 400,000 plus 18,000 minus 4,000 minus 10,000. Okay, so it's just the equity method securities debits added minus the equity method securities credits is all it is. Okay, so it's going to be 400,000, which is not that number, 400,000 plus 18,000 minus 4 dividends, 4,000. Thank you. This is not a touch screen, which drives me up the wall. If you have a touch screen, you know, because you get so spoiled. And this is not a touch screen, so I keep trying to move things with my fingers and it doesn't work. Minus 4,000 minus 10,000. And that is equal to 404,000. So on the balance sheet on 12/31, we will report equity method securities of 404,000. Yes. The only difference would be we wouldn't have that last journal entry. So investment income would have been 18,000 alone, and the carrying value of the investment would have been 414,000. And that's it. We just wouldn't, I mean, we would ignore the goodwill and we wouldn't make that 4th journal entry, and it would be just like the equity method stuff that we did in year 3. Okay. All right. So on Monday, we will go over number 2 there. Okay. But don't forget, you can also go back and look at any of the equity method videos that you need to. But if you struggled with the first one, go back and do number 2 again now that we've gone over it and see if it makes more sense. Now, I will say number 2 is harder because I didn't give you automatically the share. Like I told you the full amount, and so you have to multiply everything by that 40% instead of me giving you the 400,000 and the 300,000. You had to figure those out, right? That was harder. Yeah, Haley. No, you don't have to resubmit it. But if you want to, it's really up to you. If you want to go back and retry it now that you've seen it again, see if it makes more sense. It's just for your benefit, I think, if you want to. But obviously, the most important thing for Monday is the analytical procedure. I am fine with you working together, but you must submit your own document, okay? So please submit your own document. So if you guys want to use your channels and work with your group a little bit, that's totally fine. But just or you're free to work with anybody else in the class that you want to. But just make sure you submit your own documents for those analytical procedures, okay? And Sandy, if you need to come see me to kind of get some, because we did year 1 in class all together before anybody had to do it on their own. So if you want to come see me and we can work through some of it together, you just go ahead and do that, okay? All right. Haley, you good?
Yes, ma'am.
All right. Well, class is dismissed. I'm going to stop recording, Haley, and you can head out, okay?
Yes, ma'am. Thank
All
you.
right. Okay. All right. Let's